Do you ever feel this way? Prices are skyrocketing, but your paycheck can't keep up with inflation. You work hard every day, yet the anxiety keeps growing. Because you know that with just one decision from the Federal Reserve, the stock market, housing prices, and even your 401k could all flip upside down overnight. And right now, America is standing at a critical turning point. If the Fed doesn't start a rate cut cycle in December, the U.S. stock market will crash first, before anything else. Why? Because after the federal government was shut down for 43 days, the Treasury used a special provision to pull $1 trillion of liquidity directly from the Federal Reserve. Do you know what that really means? It means $1 trillion of blood was drained straight out of the U.S. and global financial markets. But once the government reopens, at least $700 billion of that liquidity must flow back into the market. And once operations normalize, the Fed will have to start cutting rates. A 25 basis point cut would be the bare minimum. There is simply no scenario where the U.S. can avoid rate cuts. Why must the U.S. cut rates? America pays nearly $2 trillion a year just in interest on its national debt. If the Fed doesn't cut rates and increase liquidity, the U.S. can't refinance old debt with new debt. If Treasury bonds collapse, U.S. credit collapses with it, and the dollar oil system collapses too. Even worse, the 50-year U.S.-Saudi oil agreement was not renewed, gold keeps climbing, and the pressure on the dollar is getting heavier. Once the U.S. begins cutting rates, three sectors will surge, not just one. One, metals, especially non-ferrous and rare metal stocks. Keep this in mind. Gold spot prices usually rise more than gold mining stocks. Non-ferrous metal stocks usually rise more than the underlying commodity. When the dollar enters a multi-year rate cut cycle, these sectors typically explode upward. 2. Global imported inflation. Rate cuts weaken the dollar, raw materials rise, production costs rise, consumer prices rise when demand is healthy, global mild inflation, debt monetization, economic expansion. Why is America delaying rate cuts? There's only one reason. The U.S. does not want China, Japan, and Europe to enjoy a second wave of economic expansion right now. America wants to ensure that it stabilizes first. It benefits the most from any future rate cut boom, and only then will it allow other countries to rise with it. This becomes clearer when you compare the situation with China. China went from a poor nation, developing nation, BRICS nation, emerging market, now just short of developed country status due to per capita income. But in economic scale, supply chain depth, and export capacity, China already operates at a developed country level. And every nation that transitions from developing to developed status needs three engines: stock market, consumer growth, and financial investments. The U.S., Europe, and Japan all rose this way. Financial markets create wealth, middle class expands, consumption boosts GDP, technology upgrades, the country advances. But right now, the U.S. is suppressing rate cuts to slow down everyone else, delaying global growth so America can run ahead first. What does this mean for everyday Americans? If the Fed keeps dragging its feet in December, the stock market will drop. Corporate financing costs will keep climbing. Unemployment will continue rising. Your retirement account, your home value, and your investments may all take a hit. But once the U.S. finally starts cutting rates, liquidity will return to the market. Metals, resources, and equities will surge. Household wealth will enter a new growth cycle. In simple terms, the longer the delay, the longer the pain. Once rate cuts arrive, assets will rise, but the rest of the world will be pushed into motion too. America right now is using a delay strategy. Stand firm first, then decide how the global economy will move next. Our channel is to focus on important financial events in the world, get high investment returns, and release 2 to 3 videos every week. See you in the next issue.